The topic of this video is why do investors ghost you even after they've shown you really strong levels of interest? Before I start, quick bit of context. If you're watching this, you're probably either a sponsor who's trying to raise money, raise capital, or you're someone on the investor side who's been pitched enough pitch decks to last you a lifetime. Either way, this video is for you. Because one of the most frustrating things that I hear consistently is, hey Sav, they were really interested and then they just disappeared. They ghosted us. If that's happened to you, you're not crazy. Ghosting is a thing. It does happen. But you're probably misreading what actually happened in the moment. So let me say this straight. Investors don't ghost because they changed their mind. They ghost because a decision in their mind never really truly stabilized. That's actually it. It never crossed the internal line where they felt safe enough to move money and allocate funds. There was probably something still hanging in the air, right? Something unresolved. And once that forms in their mind, it's very hard to reverse. So when an investor says, hey, this looks interesting, most sponsors internally translate that as great, they're in. But no, that's not what that means. All that actually means is I haven't seen enough to reject this yet. Now that's curiosity. Curiosity is a good thing, but it's not actually commitment. And there's obviously a big difference between those two, right? Interest is all based around emotions, and commitment only really happens when uncertainty is actually removed from the equation. It's where there's nothing really left unanswered, where there's no loose ends for them to tug on later. And most raisers, they die right there in that little gap. Now let's talk about what's actually happening in their head. When someone says they're interested, what they're actually doing is they're kind of scanning for holes. They're comparing you to something else that they're currently looking at. It's kind of like pattern recognition. They're testing how clean your structure is. They're watching how you as a sponsor behave. They're not necessarily thinking, wire money over to this company straight away. They're thinking things like, what am I missing? Why does this deal still feel kind of funny? Is it some few loose ends here which I can't really put my finger on? Where exactly does my repayment come from? What happens if I'm the first one in? I don't want to be the first one in. I don't want to bear the weight of everything on me. What happens if something slips? If there's timeline slips? Who's the authority? What are their protocols for handling that? They're really looking under the hood trying to figure out whether or not it's a safe place to park some money. They're comparing you to also other deals that they're looking at. So they're making those direct comparisons. They're testing whether your structure ultimately holds up without you having to talk them through it every time and reassure them. Because if it doesn't, they're going to drift, and drifting basically looks like ghosting. So here's what I see sponsors do every time. And I do actually see this over and over, right? An investor goes quiet for a few days. The sponsor or the investment sales associate speaking with that prospective investor starts to panic, right? And then when that happens, they start coming up with follow-up emails, right? You start sending long emails, then a text message, then another email with attachments, then, hey, I'm just checking in, happy to jump on a call. From your side, that feels kind of proactive, feels like you're doing your job. That's what you've got to do to get an investor over the hill. But from the investor side, it feels like sales pressure. And the decision starts to become heavier for the investor, right? Because instead of clarity, all they've got is all this extra information that they've sent them that they now have to process. There's more PDFs, there's more explanations, there's more signals that something still needs explaining, and more signals as a whole for things that need to be explained makes them feel like this isn't as self-contained as it should be. And when something feels like that, basically it feels unresolved, more chasing is not going to calm it down. It just kind of highlights that something's not right. And as a result, that hesitation doesn't disappear. That sense of certainty doesn't exist. So it kind of just goes underground. The investor starts ghosting you, right? That's where it comes from. So let me give you a small example. An investor says, hey, I love the deal. It looks great. Then they send you an email saying something like, can you clarify how that early exit works? How does that work exactly? How do I get my money back? That's not a rejection. That's a structural probe, right? They're asking a legitimate question. What are the exit mechanics? How am I going to get my money back? If the exit mechanics are clean and obvious in the paperwork, you've got clear waterfall structures that you don't need to put into ChatGPT to figure out. There's a clearly defined repayment source with written timelines in place for when those exits can take place. The question really doesn't require 4 emails and 10 follow-up calls to get the answer across the line, right? But when it does, and we've all been there, you start writing one paragraph, then another paragraph, then a call, then a follow-up call. That's the moment when the decision kind of destabilizes. It's not really when they say no. It's when they actually sense something that should have already been locked down. And once a decision destabilizes like that, it rarely recovers cleanly. Now, let me give you a real example. This is not theory. This is really something that I'm actually dealing with right now in real life. We've got a very large investor. We call them like family office level investors, right? They're still retail. It's still an individual, but they're effectively an individual with a boatload of money, right? They're very sophisticated too. They're really experienced in the real estate investment business. And they've just deployed $40 million into a 1031 exchange. And they've got another $20 million earmarked for another multifamily deal that they're looking at. And here's the thing. They've just got an additional $6 million in a cash refi from another property. And that $6 million is burning a hole in their pocket and they want to deploy it. The good news is that they're looking at one of our client sponsors' deals. So clearly, with all that money I've just explained there, it's not a money or liquidity issue, right? They've got money. they love the project, they like the sponsor. We've pretty much ticked most of their boxes and they are serious operators. But it's been months and nothing's happened. They haven't sent any money. Weeks have gone by, months have gone by. We re-engage with them. They then re-engage with us. Conversations are always pleasant, full of lots of questions, very detailed. The interest is certainly there, but still, no money's wired. Why? Because under the hood, the investor can't see enough. Look, our client sponsor in this case has a pretty new fund. They're a pretty new organization. And because of that, there's no long audit trail. So the repayment mechanics that they're saying is available to the investor aren't really crystal clear in the agreements. The pre-sale agreements that they were talking about weren't shown in full initially. So their due diligence in the data room really wasn't up to par. So what do we end up doing? What do you think we do? We're backpedaling. We're having to go above and beyond to make things right. We're flying them out to location. We're introducing them to our sponsors' counterparties who, in this case, are actually national home builders. We're sharing all the wet signed agreements that we have. We've actually gotten to the point where we've talked the sponsor into sharing some of their personal financials to show that they're actually solvent. Will that get the job done? Maybe. But look what we have to do just to get back into the conversation. It's been 6 months of straight friction. That's not timing being wrong. It's not because the deal's bad. It's because the structure didn't make certainty obvious from day one. And that's the difference. If certainty isn't embedded up front, you're going to end up having to try and engineer it in real time, which is essentially what we're doing. And once someone leaves a call thinking, I like it, but something's unresolved, you're already going to be on your back foot. This is really important because a lot of sponsors don't like to admit this. You see, when capital is flowing, you tend to relax. I understand it. I've been there. When investors are leaning in, you assume it's solid. When the checks are coming in, you think, yeah, we're good. Momentum feels like kind of proof that everything's a success, but that's not what it is. Momentum just means that you have something that can sell, but structural durability means something that's actually stable, and that is a different thing entirely. Sponsors love telling themselves stories like, well, the investor must be just busy, or it's a quarter end, so we just wait till the next quarter, or they're just waiting on liquidity like they told us. Sometimes that is true, but most of the time it's a stall tactic, right? It's just uncertainty that's never getting resolved, so they're stalling, they're ghosting, right? So time doesn't necessarily fix any kind of structural doubt that's coming from your operation. It's going to really just cement it. Busy people still deploy capital into deals that they actually trust. The fact is, if someone was certain, they would actually act and money would move. You'll see those allocations take place. Think about it like this. Every investor has a line in their head. Below it, it's all about curiosity. And above that line, it's all action. Ghosting happens when your deal is just under that line. They don't necessarily hate it, but they don't love it enough to move money into it. It just never crosses into, yeah, I'm comfortable with this. Here's some money. And that's what you need to engineer, what you need to manufacture. And it's actually what helps stop that ghosting. It's not more follow-ups. It's not more charm and personality. It's not better objection handling. It really comes down to how you've structured the opportunities. It's all about structure. You want an offer that explains itself, the mechanics that are really obvious from day one. The exit paths need to be completely mapped out. The risk handling needs to be completely visible. And the momentum that you're demonstrating needs to be real and not forced. Investors need to know where this deal stands, who else is in it, what happens next, how is my money going to come back to me. They don't want to feel like they're carrying this thing on their back. So let me put it plainly. If your deal needs you to explain it for 45 minutes every time you're talking to somebody, you know it's not tight enough. If someone else asks, so exactly where does my repayment come from? That means it wasn't obvious to begin with. If protections only exist because you're having to verbally promise them, then you've got a weak structure. Sophisticated investors don't really invest on reassurance. They invest on mechanics that they can actually see. Your job isn't to chase interest in that sense. Your job is to remove every reason why someone would hesitate on your deal. You want the mechanics answering those questions before they're even asked. Because once someone leaves a conversation thinking, I like it, but ... you're already playing defense. You're on your back foot. So before your next raise, ask yourself, if I removed myself from this call completely, would this still convert? Would the documents alone stabilize the decision in their mind? Would someone seeing this for the first time understand instantly what it is, where it fits in their portfolio, how the risks are handled, how the exits are funded? If they can't, you're going to expect that ghosting should be predictable, right? Interest is generally easy to get. Just show some big numbers, show some upside. You can get interest all day. But certainty is really the thing that moves capital. That's what builds reputation. So build for certainty, engineer stability. Stop confusing momentum with safety, and you'll start seeing that ghosting will start to disappear. So if any of this is hitting home for you, or you're tired of chasing people who are really interested, then you know why this all already matters. I'm actually building a group for sponsors who actually want to fix this property, not like surface level tweaks. I'm talking about really something structural that actually works. Not going to be sharing how to make a prettier pitch deck. So if that's you, the link is below. Interest, remember, is easy to generate. Certainty is what actually moves the money. So get your structure right, build for certainty.